Hello and welcome to U.S. Stocks. This is your direct briefing on the U.S. stock market. Today is Friday, October 3rd, 2025. We stand at a fascinating juncture. The third quarter earnings season has just wrapped. The Federal Reserve's next move is the subject of intense debate, and investors are trying to price in the economic realities of 2026. Over the next few minutes, we will dissect the current market action, dive deep into Wall Street's latest price targets and sentiment, and map out the potential headwinds and tailwinds on the horizon. Let's get straight into it. The current market snapshot. First, the numbers. As of midday trading, the market is mixed. The S&P 500 is hovering just below the psychologically important 5,300 level after a week of choppy trading. The tech-heavy Nasdaq composite is showing modest gains, buoyed by renewed optimism in the semiconductor space. Meanwhile, the Dow Jones Industrial Average is lagging slightly, weighed down by concerns over industrial production and consumer discretionary spending. And one highlight stock, currently trading at $35.40, is drawing special investor attention. So, what's driving this action? There are three primary forces at play. 1. The Federal Reserve. Last month's meeting confirmed a continued pause on interest rates. The market has largely priced this in, but the dot plot shows a divided committee on the timing of potential cuts in 2026. Every piece of inflation and employment data is now being scrutinized for clues. This week's slightly cooler producer price index report gave the bulls some fuel, but a still tight labor market report is keeping that optimism in check. 2. Corporate earnings. Q3 earnings were decent, not spectacular, but not disastrous. We saw continued strength from big tech, particularly those heavily invested in AI infrastructure. Companies like Nvidia and Microsoft beat expectations. However, guidance was cautious. Executives from retail and manufacturing sectors spoke about consumer fatigue and supply chain normalization, which has tempered enthusiasm. 3. Economic data. The narrative of a soft landing is still alive, but its pulse is faint. GDP growth for Q3 came in at a modest 1.8%, and leading economic indicators are pointing toward a slowdown as we head into the new year. The key question is whether this will be a gentle deceleration or something more abrupt. Sentiment and price targets. Market sentiment can best be described as cautiously opportunistic. The CNN Fear and Greed Index is hovering right in the neutral zone. The CBOE Volatility Index, or the VIX, is trading in the mid-teens, not indicating panic, but high enough to suggest investors are hedging their bets. There's a palpable tension. On one hand, the fear of missing out on a potential year-end rally is strong. On the other, the risk of a policy mistake by the Fed or a sharp economic downturn is very real. This cautious mood is reflected in Wall Street's latest price targets. The consensus is slowly building for the S&P 500's year-end 2025 target. Goldman Sachs recently reiterated its target of 54.50, citing resilient corporate profits and the tailwind of AI-driven productivity. Morgan Stanley, taking a more cautious stance, sees the index closing the year closer to 5,200, highlighting risks of margin compression and a slowdown in consumer spending. JP Morgan sits in the middle, with a 53.50 target, calling the market fairly valued at current levels and in need of a new catalyst. What's more interesting is the sector-level analysis. Analysts are upgrading healthcare and utilities, traditional defensive plays, suggesting a flight to safety. At the same time, select technology and communication services stocks continue to receive buy ratings, though with slightly trimmed price targets. It's no longer a buy-everything tech market, it's a stock picker's environment. The market is rewarding companies with strong balance sheets, consistent cash flow, and clear paths to profitability, regardless of sector. Future outlook. So, where do we go from here? The path forward will be dictated by the interplay of inflation, Fed policy, and economic growth. The primary tailwind, or positive catalyst, would be clear and consistent data showing inflation is securely on a path to the Fed's 2% target. This would give the central bank the green light to signal rate cuts for early 2026, which would almost certainly ignite a broad market rally. Another potential positive is the continued rollout of generative AI, which could start translating from hype into tangible economy-wide productivity gains, boosting corporate earnings. However, the headwinds are significant. First, the risk of sticky inflation remains. Any unexpected rise in energy prices or persistent wage growth could force the Fed to maintain its restrictive stance for longer, choking off economic growth. Second, the long and variable lags of the Fed's previous rate hikes may finally be catching up to the economy. A sharper-than-expected slowdown in employment and consumer spending could trigger recession fears, leading to a significant market correction. And finally, we must not ignore the geopolitical landscape. Any escalation in global tensions could introduce a new wave of uncertainty and risk aversion into the markets. Conclusion. To summarize, the U.S. market is in a delicate balancing act. We have the supportive force of technological innovation and the hope of a Federal Reserve pivot weighed against the very risks of a slowing economy and persistent inflation. The consensus from Wall Street is one of modest gains from here, but with heightened volatility. The easy money, driven by stimulus and zero interest rate policy, is a thing of the past. The path forward requires careful navigation, a focus on quality, and a diversified approach. Don't chase momentum blindly, but don't let caution paralyze you from seeing the opportunities that always emerge in such an environment. That's all for today's market briefing. This is U.S. Stocks. Don't forget to subscribe, share this video, and drop your thoughts in the comments. Stay informed and stay invested. This is U.S. Stocks. Don't forget to subscribe, like this video, share it with your friends, and leave your thoughts in the comments.